Hi, this video is to explain how to use the spot gamma levels and the other tools that you can use every day for trading in order to use the gamma exposure information from all the options markets. In this case, I always use the SPX, NDX, XPY, and QQQ levels. How you can see it here, this is the spreadsheet that I upload every day in the channel, in the Telegram channel. This spreadsheet, the all information that is there is about the spot gamma levels. All this information is extracted from the spot gamma software from here every morning. For example, here is the gamma levels that are extracted from the spot gamma from the SPX, SPY, NDX, and QQQ. All the levels here are the most important gamma level from the ladders of all markets. This information is extracted from the date, of the day, of the actual day. The information that I upload in the spreadsheet must be updated every morning. On the other hand, speaking a little bit about the significance of what mean this name, maybe a lot of people are familiarized with this information, but here I want to explain a little bit about this. The large gamma are the most important Gex exposure levels of the ladders. In this case, the L1 has more gamma than L2, large gamma 2, and large gamma 2 have more gamma than large gamma 3. In this case, this is important because maybe the price will react with more or less volatility in that zone. And the combo have the same signification. Here, the combo 1 is more important than 2, 3, and 4. Why? Because combo have more gamma than 2, 3, and 4. And this is the merge between some Gex exposure from XPA and XPY in the same price level. What do I mean? That combo 1 is shared for combo 1 in XPY. They have in both option ladder a significant gamma exposure there. For that reason, spot gamma put here the combo because the price react sometime in that combo. On the other hand, the call wall and the put wall are the extremes of the ladders. That gamma level are one of the most important when price is in extreme in the all session day. Here, the upper daily expected move and the lower daily expected move. This is a calculation made from the how the gamma ladders and the gamma levels have an extreme for the session. In this case, the extreme upper are the upper daily expected move, and from low to the low par from the session day. This is calculated from the closed price in the day before. This last closing price. This is calculated from only from SPX. All these parameters that I use for transform XPX gamma level, transforming from SPX to ES. This parameter I extract from two main indicators that I have built in for TradingView that you can download from my website. That's two indicators. You can calculate the difference between XPX and ES, and you can calculate the final number or the final value that automatically is calculated from SPX to ES. This calculation is making too for NDX. I do the calculate for NDX options and transform it to NDX NQ. All this information from for NQ and ES is that I load every morning in the NinjaTrader platform. Also, I load the calculation or the spread, the ratio spread between between XPY and ES. All this number is the ratio between SPY and SPX. Also is calculated for QQQ, and this data is transformed for NQ. All these numbers are the calculation. As you can see here, that level ID are only a resume from the main levels. It's the same names, only that I write large gamma 4. This means that is L4, combo 2, C2 are the same. It's more practically for me to show in NinjaTrader the level ID than all the name. Also, you can download the spot gamma Gex information that I extract from here, from the website, spot gamma website. All this information I copy from here and paste here in this section of the spreadsheet. Why I pasted this information here? Because some traders use this information different that I plot here in this section. This is passed for using in TradingView platform. What you have to do is only to copy this information and paste it in TradingView platform. Remember that I loaded a video about how to use this spreadsheet in NinjaTrader, in TradingView, and how to load in Bookmap. Okay, this is an introduction about how to use the spot gamma levels in all the platform. Now I want to speak about the how to use the GexBots software or the gamma levels 0 DTE information. Remember that GexBots give us the 0 DTE information has leaf data. This data is a big value information that I use every morning for trading. But first of all, I want to speak about how to make or how to put in practice a strategy that has been working for me for a lot of time. And this information here you can download from the Telegram channel. And here I want to speak a little bit about how to use the gamma levels in your platform or for your trading day, for trading. Okay, this is a Gex Playbook. This is your step-by-step guide to reading the market hidden structure. Remember that trading in the fog is one of the most difficult part because sometimes we feel that the map for trading is not clear. But what happened? The market often feels like a random, unpredictable battlefield. Without a map, traders are left guessing, reacting to noise and fighting against uncertainty. This leads to emotional decision, not a strategic one. Now I'm going to speak about the Gex Playbook and how to use the spot gamma levels in your platform like a strategy. Trading in the fog, the market often feels like a random, unpredictable battlefield. Without a map, traders are left guessing, reacting to noise, and fighting against uncertainty. This leads to emotional decisions, not strategic ones. Maybe sometimes do you feel like this, like the chart is not clear and all the information that you has been using for many times is not so clear. But what if you could see this hidden structure that drives the price? A structure that you can conduce your trading in a good way and a safety way for trading. The market has an engine room. Here is the key. Introducing the Gex framework, a methodology for anticipating market structure and a behavior by analyzing gamma exposure from the option market. But what happened? The auction market, in this case, the SPH and NDX, is the force that is generated here in the engine room. We use this institutional data to see the true market structure. And what next? All this force, all this engine room give the force to conduce all the information to the wheels. Who is the wheels? The future market. In this case, ES and NQ. This is what you drive, the primary driver of order flow in the future market. Let's go to decoding the two market regime. This is the most important part for today's session. Read the market regimes. We have two market regimes. One of these is when we have a get plus environment. I have named this as the gravity zone. The other one is when Gex is negative or a negative environment, Gex. I have named this as the acceleration zone. In the Gex, in the positive Gex, dealers are long gamma. Okay, all the information in the gamma ladders, more than 70% is positive gamma. This information gives us every day a good sign for the direction or the zone that we are going to in the session, in the daily session. If dealers are long gamma, then the market tend to mean reverse. There could be or there will be low volatility, and we expect there is range and bounds behavior. The main strategy there is use the max Gex level or the max gas positive level as a magnet. Always trade the pullbacks toward the level or fade at this level when price hits this level, the max positive Gex level. In the negative gamma levels or the Gex negative environment, in the acceleration zones, dealers are short gamma. The market is prone to breakout. There is high volatility and big directional move. We do not expect here a trade against the price. The main strategy here is use the max negative Gex as a magnet level for the target. If this level is broken, use this as an acceleration zone. Trade momentum and continuation. Let's go to see this in a practice picture. Know your battlefield. The three key Gex level. We have three zones. First, the one is the level 1, mass Gex positive level or the positive gamma levels that I have named the wall. This acts like a powerful magnet when price is down this level, pulling price toward it and often causing reversal. The peak of gravity zone from here. Level 2, the zero gamma, the pivot. This is the critical line in the science. Crossing this level signal a potential shift in the market region from gravity zone to acceleration zone or vice versa. This is the zero gamma level. This is our pivot. This is our line in the sands. And the level 3 is the most volatile zone there because dealers are negative gamma and they have to go with go with price. This is a level where price can accelerate dramatically. It acts as a target in a downtrend and a potential long pass if this is broken. I'm speaking about this level. This level is so important. And from zero gamma to the max negative level, Gex negative levels, this is the zone where you can estimate high volatility. And from the zero gamma to max positive gamma, there will be less volatility. I don't want to speak the detail why this happened, because I wanted to do this information for traders that are new, hearing about option market and how to use this information in future market. For now, you don't need to know about all the detail, but what produce all this effect, all this information, because option market has a mountain of information that you need to know to understand how this market functions. But for now, I think that this playbook will give you the information, the basic information that you need for make a day trading efficiently and try to do positive profit. Now, let's go to speak about the 4 high probability plays. Now we combine our understanding of the regimes and levels into actionable trading scenarios. These 4 plays are based on price position relative to zero gamma and the Gex positive and Gex negative levels. The first of the one is from when price going from zero gamma to max Gex positive gamma. The other is when price go from zero gamma to max Gex negative gamma. The third is when price is in a max Gex level. This acts as a wall. We can try to find a reversal trade here when price is in max Gex level, positive Gex level. And when price is at max negative Gex level, I don't think that we have to do this like a wall. Why? You can make a little research in internet about how to use the max Gex level as a wall, and some traders say that is a good trading for reversal. It's a good zone for make a trade, take reversal strategy here, but I think this is very risky. Why? Because when price is going downside, all the option dealers, market makers, traders, retail traders, they all is going with price, not against price. For that reason, that zone may high volatility when price is going from the zero gamma to the max Gex negative gamma. It's a risky to take a reversal trading here because the volatility is so high. The range are very higher, and you have to put the stop loss in a far level if you don't want to be stopped here. And let's speak a little bit about this ahead of this presentation. Okay, each of these primary scenarios carry a 70 or 80% success rate when the correct entry type is applied. This percentage is not about risk reward backtesting doing. This risk reward is about comparing the kind or the type of trade that we took in every scenario. Let's speak about the head of this information. Let's go to speak about the play one. When price go from 0 gamma to max Gex positive gamma. This is the gravity pull. This scenario here is when price crosses into the gravity zone. This is the gravity zone, all this zone, and is being attracted toward to the max Gex positive level that I have named as a magnet. Why this is a magnet? Because all dealers, all market makers here are positioned big amount of options position that they have to hedge in the same session day. They cannot hedge this position or cover this position the next day because all the data that we see here every day is 0 DTE data. This data expire the same day. For that reason, 0 DTE data is more volatile, and all the effect that the magnet levels cause here will be in the same day. For that reason, we use the max Gex level as a magnet because when price is near from the 0 gamma, the price will try to go to the magnet's level because this level has been hedged for dealers and market makers. You can make also a research about how dealers and maker make it. They cover all positions in a gamma level. Why the max gamma Gex level or positive level is so important? Because the gamma there has the big point or the big number in that level. For the day, this number of option position has the max gamma of all the rest ladders in the complete histogram. For example, the best entry when we are in a play one, when price goes from 0 gamma to Gex positive gamma in the gravity pool. First of all, we have to wait that price go from negative gamma zone to a positive gamma zone. If price go over the 0 gamma, like here in that point, then price has to make a pullback that try to retest the 0 gamma. Here we have to find confluence with using another instrument or using another information like volume, absorption, order flow information, volume delta information, and other that you want to use. Less volume here, retest the sum, information about position in the order flow, as for example, when you have there in the bookmap, you will see there buy position, liquidity position here that can stop this pullback, or you can see there stops effect, how I say, iceberg, you can see here absorption, etc. When you see this and the price start to go higher with good efforts, you will try to, you have to try to take a long position here. Why? Because we are in a positive gamma of the gravity pull. The price has to go, the price want to go to the max gets positive gamma. Also, you want to see in the negative gamma, in the ladder, you want to see less bars here or an imbalance here, less than the positive gamma regime. This is how we try with confidence that kind of strategy. When you see big bar, positive bar here, positive gamma bar here, and few or little bars, negative Gex bar here in the negative zone. This is an example how, as I say, for example, zero gamma is at 4.5 here. Then the Gex, the max Gex is at the 45.26 level. What you have to do here is wait for a pullback here in that point and enter long. What are the target? Remember that in our ladder we have support and resistance that is not 0 DTE. We have other kind of Gex level that was extracted from spot gamma, the 98 DTE. Combining this 0 DTE with 98 DTE, we have to take account all this information. The information that gives you what can find in the next zones. Here we can take a close position maybe as a primary target at the 0 DTE max positive gamma level, or as a secondary target, the 98 DTE levels. Sometimes we can find the 98 DTE level down the 0 DTE max gamma level. Be careful when you see this, because sometimes price stop in the 98 gamma level and this level don't left that the price go higher to close in the Gex level. For that reason, you have to manage your position here, trying to making trailing stop after you analyze that kind of scenario. The play 2 is when price go from 0 gamma to the acceleration zone between 0 gamma and the maximum negative gamma, has these pictures I explained here. In this case, the price fall into the acceleration zone with no gamma breaker to stop the move. Here, the success rate is similar to the play 1, 70 and 80%. The best entry here is take a pullback. In this case, sell the rip when price broke down the zero gamma and make a little pullback to the zero gamma, and you can take a position here when you see any other confluence information, as I explained in the play one. For example, here NQ break below the zero gamma at 15,000 price. This is for NQ. And then you see the max Gex negative level at 14,800. Okay, and you have, as the play one, two types of target, the 0 DTE and the 98 DTE. You can take or close your position here in the primary target or in the secondary target. This is your decision when close your position. When you see the price down with a big force, because this is a volatility zone, this is a high volatility zone, your sentiment feel that the price goes with good velocity and you don't want to close your position. But what happened with price hit this level? Sometimes automatically the price give a big reversion and retracement to your entry. For that reason, you have to do this strategy like a rule and respect that kind of target. If you decide to don't use this strategy, maybe you want to use another. But if you want to use this strategy, you have to respect the target, maybe the primary or the secondary target, because that level, the price reacts here with a big effort in a retracement direction. Maybe you can make back testing about this. But what happened if price broke this level? We expect that the price made a little reversal here and make a continuation with good acceleration too. You can take a short position here also if you see that this price broke, retest without any effect to make a contrarian movement or a reversion, and after the price start gaining velocity, you can take a short position here, and you can close the position when price hit another max Gex level in the ladders. The play 3 is when price is at max Gex positive or in the wall, like here. In this case, the price arrives at the wall or magnet zone with maximum attraction and uncertainty, creating a high probability reversal opportunity. This reversal rate is 70 and 80% of probability in comparison with broken this level. If you compare the effect of the price here, there is 70 or 80% that the price reversed than the broke the level. In this case, we have to go with the probability, and we want to take a short position here. The best entry is fade the level. When you see some pin bar when you see a spike bar, or confluence data as stops, orders, absorption, iceberg, sell icebergs, or other order flow information that gives you here. You can use this information to take a reversal position. In this case, how do you see here? You see the reversal candle plus order flow confirmation. This gives us good signs to take a chart in the max Gex level. For example, ES touched the max Gex level at 45, 25 number levels, and look for a reversal sign. Example, a weak candle to sell. Also confirm with the presence of stop, iceberg sweeps, and absorption and the order flow bookmark. The target, the primary target is the 0 Gex level. Remember that this is our pivot of the Gex ladders. The secondary target is the next 98 DTE Gex level. But how I said before, what happens if we see a 98 DTA Gex level before 0 gamma? For example, here, if you took an entry with 2 or 3 contracts, maybe you can close 1 or 2 positions here, or the entire position here, because the 98 Gex level here are very, very important. Depend of the session, this level adds support, very good support, inclusive for take a long position. And the fourth place is when price is at max negative Gex level. As I name it here, this is the void. Why the void? Because the volatility here is so high and the price don't have break here. The price is in the void with maximum acceleration, causing impulsive movement. This is a trend following play. The continuation rate is like 70 or 80%. The best entries type is with momentum. Example word, context. NQ is filing toward max Gex negative level, and the level was broken, like I showed here. What is the action? Wait for a small pullback or consolidation to sell after this breakout. If you see here no more volume, or you see here confluence that helps you to take a negative to take a short position here, because you see here stops, iceberg, sell iceberg, or more absorption position, sell absorption position, you can take there a short position, and your stop would be here before the previous higher low, or before the 0 gamma, if it is possible. What is the target? The next 0 DT Gex level, negative level, or the 98 DT Gex level. Now, how you master in your entry? This is a probabilistic approach. High probability, I state 70–80% of success rate. Here, if you are from 0 gamma to max Gex positive level, entering a pullback when price cross the zero Gex level and take a long position. But what about if price is at the max positive gamma level? You can fade the level, trade against the move when the price touches the max Gex positive level. But what happens if price is at the max Gex level? Jump to the current trend after brief consolidation following the breakout if this level is broken. What about the low probability? 20 and 30 success rates. Take account this. Remember that max Gex level is a word. If price break out this level, exists high probability that price come back against to the max Gex level because this level market maker have to cover this position and they are in a long gamma. They don't want to go higher because the gamma here gives them the opportunity to cover or hedge their position. It's no reason to go higher. For that reason, there are 20 or 30 percentage of success rate. Breakout here, take breakout position here is high risked. Also, the low probability is when price hit the max Gex negative level and we try to take a long position. When we are in a negative Gex zones, in acceleration zone, why we want to take a long position if here the all ladders gamma level is negative? Option trader, dealer traders, retail traders, they are taking a short position here. They don't want to take long position here in that kind of scenario. Why do you want to take long position? This is a risky probability. Take a long position there. Okay, the golden rule of Gex trading is that in positive raging Gex, think like a contrarian. Why? Because when price is going up, the dealers or market maker, they are selling option. For that reason, price don't have high volatility. They buy when price go up, they sell option position or future position, and when price fall, they buy future market. But what happened in the Gex regime? Think like a trend following. Why? Because when price is falling, dealers and market maker also they are selling option and they are selling future too. Be careful in that regime for taking long position. Okay, the per-fly checklist. Try with discipline. Maybe you have your own parameter for take your position, but I can give you some tips here. Freeze in a pre-trade. First of the ball, identify price position versus zero gamma. Where is the price versus the price the zero gamma levels. Second one, determine the scenario. What of four scenario we can to apply in my trade? What I have to do when I see a type of scenario. Third, identify the next key gamma levels. Then confirm with order flow in BO data. If you don't know what is in BO data, remember that this the CMEA data that you can show or see in bookmap. The MBO data give us all the orders classified for future market. For example, the iceberg, absorption, sweeps, and stops orders. Then apply the entry based on probability. Risk management. I think that you can risk per trade 1% of capital. If you are making a test in a maybe if you are making a test in a prop firm, if you have an account that you have to respect the trailing stop, or you have to respect the daily drawdown, maybe you can reach a percentage that can work for you, depend of the amount in your account. Okay, this is I'm not going to speak about this because maybe you have your own rules. This is another information that you can take account. Maybe don't trade 30 minutes before microdata, or when Gex is neutral or contradictory, when VIX is rising plus than 5% intraday, when we have more than 15 or 20 in volatility index, is so risky to take position because our stop has to be higher than the normal. For example, in Nasdaq, you have to put your stop loss maybe 40 pound far. Okay. I'm not going to speak about this because this is the Greeks, one of the Greeks important for option trading, but I'm speaking about the volatility, that is the intensity. Remember that 15 to 20 is higher volatility, and your stop has to be higher than the normal. The skew is make you the directional buyer. Maybe you can make a research about how function the Greeks in options in option market, but this is not so important for you right now, because what you have to know here is how to read the regime. This presentation is for that. How to use the regime when I have big amount of positive gamma, or when we have a big amount of negative gamma. I name it here this as a imbalance in gamma exposure. When I saw imbalance in gamma exposure, I tried to take position or to take position in the direction of the gamma that privilege for us. Okay, this is only a cheat sheet that You have all this information in the channel. You can do load from there and try to this such infography that can make you a big knowledge about how to use this for your day trading. But remember that the key is to adapt your mindset and entry type to the market structure. The zero gamma line is a critical pivot. This is the line in the sun. Remember this. Okay, now I want to speak about some examples. But this is one of the letters that you can find in some platform, free platform, and how to read this. In this case, the positive gamma is in the left. This is an example for SPY, the net Gex for 98 DTE. This is the 98 DTE that I every morning extract from spot gamma and I plot in the NinjaTrader platform or in the Excel sheet that I give you every morning. All these levels, here. For example, this is how you can see the large gamma 1, this is the large gamma 2, this the large gamma 3, and this could be the large gamma 4. This is how spot gamma classify the large gamma. And the combo, the spot gamma classify the combo is when price, for example, here the SPY, this number, in the using a conversion between XPY to SPA. If in the SPX there is a big, for example, this is the zero gamma in spot gamma. If you see in XPY a big gamma here, but in SPX, this is SPY. But what happened if in XPX we see a big Gex in the ladder? This is SPX. But in SPX, the price using a ratio for SPY, both are in the same point. In this case, this boot is named combo 1 or combo 2 or combo 3. Mixing this boot gamma. For that reason, spot gamma classify this information as combo. Okay, let me show you in spot gamma here. Okay, here. For example, when we are going here to the index, and you see here the XPX, and go here to combos, see here, SPX combo drive. This combo is the same position. Sorry. This combo, these are in the same position for XPX and XPY. See this, how the number, the bars maintain, but the price change. See the price, for example, here. Look at this is the SPY and the bar are in the same position. What does it mean? That is a combo. In this case, this gamma and this gamma is shared for XPX too, not only SPY. See here, this big X level acts like support or resistance too, depend of what regime we are, in a negative regime or a positive regime. Okay, continue with this. Let me speak about what this line means. This line is the total volatility trigger. What happened when the net gets positive? Make the difference, the calculation or the difference between positive gamma and negative gamma in a net continuous in a continuous difference, net difference. You can see this line pointing as a pivot here, and this pivot gives us the line on the sands when the price can act as support if price is over the volatility trigger. This explanation is also for zero gamma, okay? Because zero gamma always is close to volatility trigger. You can make a research about what is the difference between zero gamma and volatility trigger. But both, we have to read both as the same context. Okay, the price go down and touch the volatility trigger. Maybe the price act here as a support on this level, but if price broken, the price gain volatility downside, and the context here, you have to read the context here, such like a negative regime. Remember, this is a negative regime, and this is a positive regime. Okay. Who mark the line in the sand is the volatility trigger and the zero gamma. Okay. Here on the left, on the right, is for the 0DT data. These Gex levels are more sensitive than the 98DT. Why? Because 98DT means that all this level expire in 98 days, but that bars or that Gex of that option position expire in the same day. This means that all these gamma levels, these big gamma levels, has to be covered or hedged in the same day. This money here loss or gain in an exponential movement. Here the same, you can see the volatility trigger 2 and the zero gamma that will be close to the volatility trigger. I'm not going to to make a detail how to read all the information. You can use this video to, to research a little bit about how to use the ladder. This information, you could find this in the VR trap option in Discord. Okay, let me show you how this Gex can act as support or resistance. The first that we have to find every morning is to know where is the zero gamma and the volatility trigger. These two signs give you the line on the sands. For example, here, price is going and is making a higher high, but then go down and takes the zero gamma and go higher from zero gamma to L3. Remember that L3 is the third important large gamma. Price broke and make a pullback here and retests the two Gex levels. One of these is L3 and the volatility trigger. Think as a contrarian. What's a contrarian? Because when price cross this level and cross this level, the market maker and the dealers, they sell future or option when price go higher and buy when price go down. For that reason, the volatility decrease here. But when price is down, volatility trigger or zero gamma, the peaks become higher. Okay, continue with another example. Here another example. The price broke this level, these two levels, volatility trigger and L2, broke, make a retest and go down. Maybe you can try to take a short position here, or maybe in that level. When do you get out? In the close of the previous day. This is the close of the previous day. This level is named in my Excel as last close, LSC. The close of the previous day, I have this search as this name. LCS, last closing, that's last previous closing. I only put the last previous closing from XPX and NDX. You will see this information also in the trading view. I'm sorry, you will see this information only in the platform when you can load this. For example, in NinjaTrader, this is the NDX to NQ transformation, QQQ to NQ, SPX to S, XPY to EAC Ninja, and in Bookmap, we have a mixed here where you can load the NDX plus QQQ to NQ and continue. You can see the level for Jigsaw 2. And here in dictionary, this is all the links that you can use for load all the information, spot gamma, and my own parameter calculation in the platform, in your platform, using this link, these CSV links. For example, this is for Ninja, these 4 links, and these 2 is for bookmap, and this is for Jigsaw. Okay. Here, how I say price go down. After this, price broke the volatility trigger and L2 and make a little pullback. Maybe we wanted to the price make a pullback to L2 or volatility trigger and make a higher high and try to go long here, but price didn't this. Here another example. See how the price retests 1, 2, 3, 4, 5 times the L2 for XPY gamma level. This is important to know that I want to explain here that the blue is for XPY and all the white level is for SPX. Also in NASDAQ, NDX. White is for NDX and blue is for QQQ. Okay, this is so important because I make difference between big index or the main index and the ETF market. This is ETF, SPY in this case, and this is the index levels. So remember, blue is for SPY and white is for SPX. All this information both are recalculated and transformed every day for use in ES and NQ future market. Here another example. See how many times the price touch our gamma levels. See, price touch here, here, here. See how the price reacts to the gamma levels. Also, this is 98 DTE gamma level. This is not 0 DTE. This is only 98 DTE. 98 day to expire. This is the date when all this level will expire. It's not today the expire. It's all the ladders that expire from tomorrow, from day 2 to 98 days. All these ladders are summarizing here and plotted in that level and classified by spot gamma. See how the price touches many times there. See here, 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 and continue. Let's see another example. See here how price go down, touch the volatility trigger, try to make a lower low, but couldn't. It made a higher high, broken this level, broken this higher low, this level, broke, make a lower high or a higher low, broke the volatility trigger, make a higher high, retest the 1-day expecting move, and after this, broke with a big candle. In this case, you can take advantage of this and take a long position here or here. Why? Because we are in a positive regime, okay? And also, if you use the 0 DTE levels, you want to see here big bars in the 0 DTE levels and downside in the negative Gex regimen. You want to see few or Gex negative gamma levels with lower gamma. When we see this imbalance, big imbalance, comparing this between this, you can take advantage because price want to go higher to these levels, to these 0 DTE levels, and we have all this confluence, 98 DTE levels and 0 DTE levels. More ahead, we are going to see more examples. Here another example. See how the price touched the L2, large gamma 2, also touches the combo 3 many times, here, here, here. What we expect here? Maybe in this context, price broke higher, make a higher high, retests, and make a lower high, sorry, a higher low. And after this, if price start to go higher, we can take a long position here. Okay, now speaking a little bit about GexBot. GexBot is all about 0 DTE data. What I say before, we want to see an imbalance between negative gamma exposure and positive gamma exposure. What does it mean? That the expectation for the day is that the price will try to go in the direction of the max Gex level in the regime. In this case, the regime was positive and we want to go to the big level here because these are the magnet zone. Downside, there are not expectations that price go there because you don't see here big position from dealers or market maker that they have to hedge or they have to cover in the same day because this is 0 DTE option position. Here in the SPX2, see the imbalance in Gex. Fewer negative bars, but higher positive bar. Where is the max Gex level? Here. The magnet zone is this. If we are here, this line is the 0 gamma. If price go higher and touch, retest the 0 gamma and start to go higher, we want to go long from 0 gamma to the max positive Gex level. I want to say that this position are calls and this position are put. In all this video, I have not speaking about the type of the position because for now, do you need what is a call or what is a put? Maybe they confuse more. But the ladders in option ladders are represented for call position and put position. Maybe this position has long calls or short calls, and downside maybe these are is a merge for long put plus short put. You don't need to know just now the difference between this and this ladder. What you want to see here for future market, if you trade ES or NQ, what you want to see here is only if the calls are major than the puts. The name is the real name is in this type of data is the gamma, because here we are representing the gamma exposure, okay? The gamma exposure in the ladders. Also here, same. See how price has an imbalance from zero gamma. This is the zero gamma, zero gamma. Downside, you don't see big bars for put position or negative gamma, but you see many bars here that need to be hedged or covered. Price will try to go here, here, and here, and try to hedge this position. Also here, price will try to go to the max Gex level, that is this. Continue. Here are the example, the same. This is the max gamma. See here that you don't see a big bar for positive gamma. And the imbalance is down the zero gamma. This line is the zero gamma. How you can see, price is down the zero gamma, or target will be here in the max Gex negative gamma. Also here, we are in a negative. How I say here, dealer have full calls and put on, sorry, dealer have more puts than call here. In this case, price will try to go to the max Gex zone, negative zone, okay? Another example. Here the same, session start here and appear this big bar, positive gamma or call position. This call position is a magnet because this position has to be covered or hedged for dealers and market maker. I don't know, but when you hear about the market maker imbalance or the strategy for ICT, maybe they don't know what is the data behind of the ICT information. A lot of traders want to speak about the value gap, order block, and other terms that they want to use for take position. But this is the real data. This is the real data that you can see to take position. No, it's not data that you don't see in only a candle. For example, when you see an imbalance in candles, but what are behind of this? What information is behind of this bar? It's better see or take account in your trading the real data, the data or the position from dealers or market makers. This is real data, 0DTE data that you see every day when traders take position to try to took longs and close position in that zone. Here the same. Maybe this is a little balance because we see some big bar positive or call bars here and put bar here, negative gamma, and maybe when session continue, maybe we can see an imbalance between both, and you take advantage in the direction of the imbalance in the favor of the big bars. Here another example: prices downside, a higher low, maybe a lower low, and then price will try to hit this level. I signed there. Here another position. See how the big bar here. Remember that the 0DTE and this get box picture are from NDX. When you see NDX, a big bar position, this position is not from a retail trader. This position is put there from a market maker or a dealer, a hedge fund, a bank, big accounts. Also here, see the price, maybe the price will try to go to here, to this bar, or go down, saying to these 3 bars here. But for NDX, it's clear that price will want to go to this level as a magnet. This is our magnet. Remember, the magnet is the level that has big gamma. Here the same. Price is going down and this bar is growing, and maybe the price will try to go to this level or this level. Same here. You can take a short position here, and when you have to close position here in this level. Also here in SPX, see the imbalance, more negative gamma than positive gamma. When you see this imbalance between 2 bars or 2 regimes, you will see the big bar has a target. Another example here, big bar downside in the put zone. You don't see big negative gamma, but you see big bar upside, and you will try to go long there. Also here, see the SPX. See how the ladder start to grow when price come higher. Where do you take position? In a pullback. If you see this imbalance between positive gamma and negative gamma, when you see this imbalance, you have to try to take a long position. When you try to do this, maybe when retest the 0 gamma, price do a higher high and make a pullback, you will try to find a long here. When you get out in the big Gex levels. Also here, maybe here the price is making higher high, higher low, higher high. You will try to take a position in a pullback. After that, you have to go to get out here in this big bar. This is another example from trades from spot gamma. Trace is similar to GetBoss, but the difference is that Trace uh, Trace update data every 10 minutes. When you are trading, you have to see or check the last checked for update, the date here, and you will see that data will be updated every 10 minutes. So this bar changes every 10 minutes. But in GexBoss, the bar changes every second. This is an advantage. But also the spot gamma trace in this case, when you see this here in this section in trace, and the powerful of this is that you can see here the gamma map. All these background color are the gamma maps, the delta pressure, and the charm pressure. You have to research about these concepts. Delta is the difference between a put and a call, the gamma in that zone, and sorry, the delta in that zone, and the gamma is the acceleration of the delta, is the derivative calculation from the delta. For that reason, we took the gamma as the most important information for future trader. Why? Because delta is the simple difference between put a call and call in a ladder, but the gamma is the change of the delta in that level. That means that when price, for example, in a long call, when price far from at the money, I don't want to speak about this, but let me show you an example. When price is at the money, the gamma has the maximum value there. So the maximum earning for a position that was taken here, for example, when price go there, the gamma has the big earn, and the dealers and market maker or the same guy that took that position will try to close the position here or take earning here, because remember that the earning options are exponential. In this case, the gamma is the most important ladders in all the histogram for Gex level. In this case, as you can see here, you see three important Gex level. In this case, these are two calls, positive gamma, other positive gamma, and this is a negative gamma or put positions. If price is here, maybe price will try to go to the nearest gamma. The nearest is this. Maybe price will try to go higher and make a pinning effect in that zone. Here another example. As you can see here, downside, you don't see big gamma bars, but if when price is here, these two gamma, this call gamma and this put gamma is here, and dealers and market maker will try to the price go higher and to test these levels. For that reason, we took long here in future market, ES or NQ. Here another example. If price is making lower low, lower high, you have to take short position and get out your position here in this level. Here another example. You take short position here and get out of this position here in this level. Here another example. See how down the price is. The price is just now here, and down this left down the price, you don't see big bars, positive or negative. You see all the sentiments option market for calls put here in that zone. In the heat map, you see these contours lines that give you the zone where are concentrating all the gamma. Okay, in this case, the price will try to go to that zone. Now I want to speak a bit about quant data. Quant data give us very, very important information for 0DTE. For example, here when you see in the net gamma exposure in the SPX or NDX and price, this blue line is the price position in the session. When price is in a positive regime and you see 1, 2, or 3 bars, big bar continuing and increasing in that direction, you will expect that price go higher because, how I said before, the price will try to go to the maximum Gex positive gamma. Price will try to go there because dealers and market makers have to hedge there. But what happened when price is here? For example, here is a big spike. For SPA, I have as a good spray more than 50 millions. And for NDX, 8 million. This is my minimum number for those two index. 50 for XPA and 8 million for NDX. But in this case, we saw 120 millions. As you can see here, it's maybe 2 times than the normal cutoff that I make every day. When I see this, we expect that the price do something here. I don't know what the price will do here, but when I see a price action here, in this case, make a higher high, and come back to retest this zone when the spike was made, retest here, and the price go up. For me, this is a good information to take a long position and try to get out here in this bar. This is confluence. This would are confluence what we want to know to take long or short position. Maybe this was a hedge, maybe this was a directional position. But remember that the option option market mostly is for hedging, not for directional position. Remember that the option market, they trade is volatility. They don't trade directionally. They don't trade direction position. They only trade VIX position. They only trade VIX position because the volatility is that make that the option market made money for them. For that reason exists short call, short put, long call, and long put. All this type of entry, that kind of entry are only taking account the volatility information. This is another example. See how this spike go higher. Maybe you can took a long here because price start to make a higher high, higher low, maybe go low here. You trailing your stop here, here. Then you was stopped, but make a good profit. If you had you saw this information here, make higher high, higher low, higher lower, higher high, higher low. You took a position here and trailing here, trailing here, trailing here. Maybe you was stopped here. You get out, you earn profit, but when price gone down, after this point when the big spike, this spike was made, you can took short position when price retests this level and start falling here, where you will put your stop over the spike position. When data give us beautiful entrance when you see that kind of spike. But the most important here is that you have to configure the net flow chart using the 0 DTE or the net flow premium in the same session, in the same day session, only taking account the position that are putting in the same day. But the other most important is that be holding position out the money. I don't going to explain this, but out the money is because the price is not the position is is far away from the earning point, from the gamma. Okay, how I explained you before. The out the money position, this point is when option they expect to earn money in the direction or with the volatility that they bought. Remember that they bought or sell volatility, no directionality, no directional position. Here another example, the price will try to go and this bar acts like a magnet. Here another spike example. In this case was 100 million of option position. The price start to make higher high, higher low, other higher high. When you see a retest, or the spike was made, you can try to take a long position in this direction. When you get out in the maximum positive gamma. If you want to know the detail of that spike, you will click on the spike was made, and this window will display it, and you will see the detail of this spike. As you can see here, you have two spike, one for call, another for put, and you will see here what is the sentiment of that position. But not necessarily you have to take in account for your trading. You have to make the analysis taking account many other information. But if you want to make this simple, try this as a support or resistance when the price action go in a direction. Sometimes price will be pinning there, but after that the price go higher with good volume, or the price go down with good volume, because we don't know if that kind of position is for hedging or for directionality. The most probability is hedging, but sometimes they impulse the price to go to another gamma levels. Here another example. This is the information about this position. See how here in the quantity the imbalance between all the rest of the position taken in that level. In this case, the sentiment here is bearish. Bearish, maybe the price go down, but sometimes always go up. Here the same. Another example. If the price is here, is the most probability that the price will be go to that spike of that Gex positive gamma. Also here you see a big spike. It's no more than 8 million, because remember that I have as cutoff for NDX 8 million, and for SPX 50 million. But here was a good spike and the price go up. Here another example. See the ladder here. Who is domining? What regimen is domining? The puts or the calls? Remember, put is negative gamma, call is positive gamma. Price, I think, is over the zero gamma, because the zero gamma is the chief between both regime. Price is in a positive gamma. Price will start to go to the max Gex levels like this, but this is the biggest gamma bar for this day, and price will try to go from here to here. If we see a spike like this or like this is confluence to go to this level, because this gives us impulsive movement. Here another example about the detail of the spikes. See here for the SPA, this spike was 180 millions, more than 50 that is my cutoff. Is 3 times from my cutoffs, 3 more times. Another example, other big bar, positive gamma. Price will try to go from here to here. This acts as a magnet, big magnet. Impulsive movement. Maybe the price will go higher or will fall. Here the price is at the big bar. Sometimes the price will try to pin in here 1 hour, 2 hours, or will close there in the session day, or sometimes the price will fall because the hedging here was making and the market maker start to sell option here. or selling future here, and price start falling. Here the target was made, price came to the big bar, but we have another one here. If price go from this price, broken this gamma level and start to make higher high, maybe the price will try to go to the max positive gamma level. Here, another example about the spike. NDX, 25 millions. My cutoff is 8 millions, 4 times more. In this case, the price start falling. Try to retest. If price retest here and start to go down, we will try to take a short position here. See here the SPX, the same, price fall, making a higher high, but in context, in big context, we are in a downtrend. But if price retests here, if broken and retest and start to go up, we try to take a long position. But if price retests and come down, we will try to take a short position here. The same information. See the quantity here. These three big spikes, meaning that this is a bearish sentiment and price start to fall. Here, another example. Price is here, we are in a positive regime. See, we don't see negative gamma here. We see more positive gamma level than negative gamma. And price will try to go to the big bar as a magnet. This is a magnet. Again, here big spike is not enough, but 5 million give that the price go higher. Here the same. Gamma is imbalanced. We see more positive gamma than negative gamma. Here the same. We are in a positive regime, in a gamma positive regime, and we will try to go from here to here. This is a balanced day for the regimes. Why? Because we see big bar in a negative gamma and big bar in a positive gamma. We don't know what will happen here. When you see here, you have to be careful because the price will be in this level that is the 0 gamma, and maybe price will start there many times, 1 hour, 2 hours, 3 hours, or maybe close there in a range. When price start in a range here, you don't have to do nothing for the entire day. You have to wait that the price make an imbalance, that this bar reduce in volume and this increase in volume, or vice versa. You need to see imbalance in gas exposure. Here another example about spike. For NDX, 8 million, this is my cutoff. Price make a spike, made a higher high, then retest the spike and start go up. I will start to thinking in a long position and start to make higher, and I will trailing my stop in that direction. Here the same in the SPA. See this. 200 millions is more than 50 million. That is my cutoff. Here the same, another spike, the price fall. Here the same, the price start to go up. Remember, configure your net flow, putting here out the money, OTM, also for SPX, out the money. Now we are going to speak about the order flow in the Gex. This is a little advanced information, but it's not so difficult to read. What we'll see here is the convexity. Again, you have to research about what is convexity in a ladders or in a regime context in option market. The convexity is how much gamma is in some levels or in a ladders. In this case, we have a negative convexity. This means that we see here more puts than more short position. This is more short position than long position in option. And this means the net Gex mean that the red is that you can see the biggest put position, and this is the biggest call position in the ladders, but for classified state order flow. The same. If you are in an uptrend, if you are in a positive regime, you are over the zero gamma, and you see that kind of bar in the order flow, for you can read this as a magnet 2, and if you don't take position for long here or here, if you take position here, you get out your profit here. You take profit here. But if you didn't took the position here, maybe you can try to take a short position when price retests here, and with other confluence try to short here and get out in the maximum put position or next or negative gamma. Other information here that is valuable for us is the net Gex. The net Gex, this line that always continue with price, and see here how the option market is the leader of or lead the future market. For example, this is the NDX, and NQ replicate the same movement than NDX. Why this happened? Because remember that NQ is the underlying market, and it is a derived market from the main index. The main index is the lead, and the lead is making directionality using all the Gex nets in the option market. How you can see here, see how the net Gex start to gain more positive gamma. See, this is the zero gamma, and start to make higher high, and the price do the same. This occurs because the option market is the lead and is the engine room, as I told you at the start of the presentation. Here the same. The Gex, see that the Gex didn't make higher high. You see here some divergence, and the price touched the maximum positive gamma, or the maximum call, and price start falling. In this case, the gamma level or the positive gamma level did not was in the same direction than the price. But see when the price touch the negative Gex level, started to go, the Gex start to make a big movement because a lot of call position start to entrance in that point, and see how the price go higher. In resume, the Gex is a valuable information if you want to use for your trade. But don't try to confuse with this because this is very important information. If you take account when you see a regimen and when you see the order flow Gex, net Gex in the direction when you took the trade. This line blue, I don't want to speak about this, but this blue is the convexity net flow. Market maker and dealers, they mostly sell option, and you can see this here, and this represent the volatility and how the volatility is decreasing when the price is go high. Why? Because dealers and market maker many times they are selling option. When if you want to take a long position, you want to see the convexity level decreasing, this line. But for not confusing more, don't take account this line. Only take account these Gex net lines. This is similar to the hero in spot gamma. The spot gamma has a hero that is represented in their tool here, and you see the hero. I don't know where is here, but let me check. Okay, in a session, you will see here the hero line. This is the nets Gex in the session, and that kind of information give us confidence to take long or short position, because hero, and in this case the Gex, the net Gex line give us is we are in a positive regime or negative regime. Here another example, see how the green line domain and give the direction of the price. The price don't give the direction of the green line. The green line is the flow and give direction to the price to go higher, because remember, this is the price, this is option position, and this option position are made for the delta and all the information and all the position in the order book for option, and is represented for delta. But remember that the gamma is represented from the derivative of the delta, and this gamma gives us more information because here all the net flow is giving us that are more calls than put. In this case is long calls because it's positive gamma. Here the same. See how the green line domain and the price go higher. Now this is other thing that a lot of traders ask me every day, how to plot this information and how interpret this information in NinjaTrader. Maybe we are 2 hours in this video, but this is one of the important part for the trader in our group. See here that I have the 98 spot gamma levels, the Gex level. Also for the blue and white, that is the one is the ETF, the QQQ or the SPY, and the white is the NDX or SPX gamma levels. 98 day to expire, DTE, 98 DTE information. And this histogram are the Gexbot bars that are representing the 0 DTE data. That position expired at the same day. And this is so valuable for scalping, because remember that when we see that kind of bar, that bar has a lot of big gamma, and that gamma has to be hedged the same day. The price don't wait for tomorrow to hedge the position. Dealer and market maker have to cover and make hedging here, and the price start to go this as a magnet. For that reason, I call this magnet. For me, this is the magnet for the day. And also we'll see here downside, we don't see any big positive negative gamma here. This is an imbalance. Remember, we want to see first imbalance. I don't see here big bars, negative bars, but we see a big histogram here for positive calls or gamma. In this case, you have to take advantage of this and try to make a long and get out your position in the big bar. This is similar to histogram for volume profile, but the context here is different, because in a volume profile you have a high volume node and a low volume node, high volume node and low volume node. Also, you had here a POC, and in the low volume node, maybe the price try to go far from this level, and in the volume, big volume node, price start to pinning when price are right there. In this case, this profile for Gex is important because the data is in real time. This is not historical. In change in the volume profile, the node that you see here are historical data. All the volume profile that you interpret every day is historical data, it's not real time. In this case, we took advantage, or we take advantage of the information that is more valuable for us, that is the real-time data. All these levels are positions that are in live in that moment. It's not historical. Market maker have to cover this position before the price close. Okay, continue. See here how the price broke the level 3, 98 DTE, start to go higher, make higher high. We took a long position maybe after broke this level or this level, and we get out in L3, or let it run if price broke, retest L3 and go to the big 0 DTE level. If we see aligned this level, and this level, this give us more confidence to take a long position or close the position when price arrives there. Let me explain you a little bit what is this layer, this layer, and this layer. Gexbot has three kinds of subscription: the classic, the state, and the order flow. This histogram here is the classic, this here is the state, and this here is the state, but is the convexity. This is the Gex, and this is the option. This is option profile Gex, and this is the option profile convexity. Gex convexity is this. Gex convexity. Okay. If you don't know how to interpret this left ladder, don't take account, only use this booth. The classic ladder is different from this because we have here all the position from calls, retails, and individual dealers or market maker. All is in this volume profile, in the in this option profile in the classic. But here you will see the imbalance option position when in the order flow. Gexbots give a good classification of the data in the state ladders, because they only put here the imbalance position that has not been taken for a counterpart in the option book. In this case, Gexbot read this such an imbalance and represent in these state ladders. But here are all the options position. This is like we can see dealer position. For example, this big number is a dealer position or a market maker position. And this is the convexity of this position. For that reason, I put the 3. This is the convexity of this position, but the classes is individual. Don't take account these 2. But these both are the same, that I only represent here the convexity, and this is the Gex imbalance. Both are imbalanced, but in this case, we can read this, that this is a blue represent the long position and purple represent the short position. You read this is a long short position. This is a short, this is a long call position. This is a short call position. When you see red here, you read this as this is a short put position, and this is a long, if this is red, put position. For that reason, we combine, or I read this every day as a combine to know what kind of position in option is in the ladders or in the regimes. But if you don't want to complicate your trading because you don't know so much about how to read option, you only take account these 2. Why? Because this gives us if the imbalance for dealers or market makers, the imbalance are positive in a regimen of Gex positive or in a Gex negative. In this case, the Gex imbalance is in the positive regime, and also all the traders, the option trader, have the conviction that the price will have a positive regime in this day. Okay, don't confuse the 3. This is all the options, and this is the classification for imbalance in the ladders. Imbalance position, and this is the convexity of this position. Here another example. As you can see here, you don't see positive regime. You only see here negative gamma. In this case, all is put. How we can read this? This is a long position, but combined with a put. This is a long put position. What happened here? In a long put position, remember that in option trading, this is a short position that the price will make big movement and faster from a long position, because remember that the option market or option trader, they trade volatility, they don't trade directionality. Entonces, they expect movement in long position. In this case, this is a long short, and after the price broken this level, you can take short and get out in the max Gex level, such as is signing here. Here another example. Nothing in our positive regime. We see imbalance. We don't see positive regime. We only see negative Gex gamma. And we will try to take a short position when price broke this level, and try to take a short position here and get out in this level. If we see downside, a big negative gamma, maybe we can trade or left to run or short from this level. But we don't see nothing down this level, and you have to take profit in this negative gamma. Also, how you can see, this is a short put. How we can read this? In a short put, they expect that the price don't move down this level, but when price broke down this level, they give us explosive movement, because they are losing money, and also they have to close their position. Also could be hedging, but mostly the hedging is using long positions. Here another example. This is one of the most beautiful examples for the day. What happened if price open here and you see this big imbalance in the regimes for this day? See this big gamma, positive gamma in the ladders, in the classic, all the volume, in the classification volume for a stake, and also in the convexity. These are the same. Remember, these are the same. Only is this information is the convexity of this position. Okay. We have green, and price it here. What we expect? See that in the 98 TTE levels, such as L1, L3, C1 in L4 was broken by the price. And if we start to making impulse here, impulsive movement here, trying to make a higher high, we have to take position and get out in this level, because this is our magnet. Here the same. Here we have a regime here, a positive, we have an imbalance here for the state classification data. A dealer or a market maker have a big position here, but all the ladders in the volume for the NQ maybe is balanced. But when we see this information, you see 1, 2, 3 bars in imbalance that comparing with this negative and price is over, we can take advantage of this because we are over the 0 DTE. This orange line or yellow line is the 0 DTE for nada. When you see this line and price is over there, you have to read this that you are in a positive regime, in a magnet regime. In this case, you can take advantage of this and take long position and get out in that level. See what happened there. Price are right there and return to the 0 gamma. Here we made another one. The price start to go up again and start to get down to the 0 gamma again. Another thing to take account is what I say in some moment of this video is that remember that the 98 DTE levels give us support or resistance many times. See how this level makes support in many points when prices are right there. See the last closing price from yesterday, from the day before. The price touched 1, 2, 3 times, and I took a long position here because we are over the 0 gamma. This is the 0 gamma, the orange line. And I took the position, but I saw that the price touched 1, 2, 3 times the last closing, and price did not arise here. Automatically, I closed this position because not always the magnet levels has most heated. Why? Because are another important levels that can stop the price continuation. Here the same, another example, 0 gamma here, from the 0 DTE, price start to go higher, making new higher high. We took long position, and when we get out in the L4 or in the gamma, in the max gamma. Another zone to take to close the position is here in this level, this imbalance, because market maker or dealers want the price go there because they have to hedge this position. Here, continue, see the imbalance. You don't see nothing here. You don't see negative gamma here, but you see big levels over the 0 gamma. Also, you will see that price touch the L3, start to go higher. Maybe you can take a long here and get out in this gamma level. Price make a higher high, start to pull back to this zone L3 that have coincidence with this gamma and start to go higher. Maybe you can take another long position here, take profit here, and another level to take profit is here in the call wall C3 or this level C. 1, 2, 3 kind of position that you can take in this session. Other thing here is that these big bars sometimes give us pinning situation when the price stop there and start making sharp movement here or lateral movement here, and price don't do nothing after 1, 2 hours. But we expect here to take a chart because this is the max gas level and is one of our position of play in our strategy. but we have to find here confluence to take a chart. Remember this. Always max Gex levels give us pinning for price. This is bookmap. Here, how you can see how the spot gamma levels, 98 DT information, the price down, retest this L4 and start to go higher. When we have to get out in these liquidity levels. Also, I use this information every day. I don't show my bookmap chart in the channel because maybe I will confuse more. But I use this because the liquidity level acts like a magnet also. It's a natural information that you can use for take advantage, because remember, price need liquidity to make movement. Without liquidity, price do nothing. Here the same, see this liquidity level in the ES, price retest the L1. Also we saw liquidity down the level, protecting a long chart, a long position here. Maybe you can take advantage here. You can take a long position. Your stop loss down the liquidity. When you get out, when you see that kind of information, stops, MBO data, that kind of information is for bookmap. They give us when the price hit stop orders. Also, the price hit big liquidity levels. What I want to represent here is when price is down the one of the level, here the L4, see how the price touch 1, 2, and 3 times and start to make lower low. Here appear in the bookmap liquidity that is named spoofing. That kind of liquidity is not so real, but try to stop price the down from this level. But what we can see here is that here are a lot of absorption data that start to stop the price, but also we see a stop price. This is buyer stops. When these are traders that take longs but was stopped, or maybe are stop position to take earnings or profit. But that kind of information give us the entire information about our movement, because if we are in a short position, we don't want to see this if price is hit by that kind of information. Bullish liquidity, buy liquidity, and stop position, because the price will stop and will start going up. Here another example. Here the same, price is going up. We see we saw a big positive gamma here. This is the classic, and see how the price moved to this liquidity and start to falling and start to make lower low. But this liquidity stop the falling of the price, and you can see how the price start to go up to this liquidity, to this positive gamma 2. Remember that all information in the ladders or in your chart must be real time. Try to not use lagging indicator. Lagging indicator as moving average also give you more confusion information. all this combination of lagging indicator, I don't recommend to use. Try to use leaf information like this. This is liquidity in leaf in real time. Also the Gex information. This is the 0DTE. All these option position or are leaf position that is acting is playing in this moment as for dealers or market maker. Here another example. See the imbalance here. Less positive gamma and much negative gamma. The price will start to fall, and see how the price, the volume here, how was stopped just in the maximum negative gamma. And you see here liquidity. That's mean that the price don't want to go down this level. Maybe here is another kind of analysis to take a chart, because the dealers or market makers don't want that price fall down this level. For that reason, they put this liquidity here. Also, you can see here 500 iceberg position for future here. If you are in a chart, you have to see to lose the position, to close the position. Another example, price is here, big gamma exposure, price go up and start to make a higher. The delta is positive. The volume delta start to go up, start to make a higher high. Also, you can see here some stops, but in a pullback, when this price make it a pullback, you have to try to take a long position and close in this maximum Gex level your position. Here another example for Gexbot or NinjaTrader, all in context. Price over zero gamma. See here, zero gamma here. This line, the orange line. We are in a positive regime. Also, we are over C1. I took the position here because when I took the position here, the zero gamma was down here. Remember that this zero gamma is dynamic. This is scaling up when price is going some direction, and all the ladders are making some summarizing for all the options here, and start making some imbalance between negative gamma and positive gamma. When price start to make more positive gamma and making big imbalance, this zero gamma start to go up. This gives you information that the zero gamma is going in your favor. This position was closing here in the maximum positive gamma. How I sign it here, that this level could stop the price. For that reason, I move the stop loss near this level, because price could stop here or reverse it. For that reason, we have to trailing or stop. This is a good example when you don't have to do nothing here. See that the ladders for negative gamma and for positive gamma is in balance. We don't see imbalance here. We see all the option position balanced. See the 0 DTE here, the orange line for 0 DTE. see all the dealers and market position are balanced with the entire option histogram. See how the negative similar to the positive bars. What you expect here is why that one of both lost the fight. If this start to reduce the bars and start and finish the bars less than the positive gamma, you can take a long. But in vice versa, if you see less or short bar and the big negative gamma bar start to increase, you can take short position down the 0 DTE. Here another example, price over 0 DTE, retest the L2 level for the NDX, broke the lower daily expected move, make a retest to this level, and when we see upper bar that give a sign to take a long position, you can take a long position and get out of your position in this bar or this bar. And your stop loss could be here. Here another example, price go up, price go up. When we get out in this level or this 98 gamma level. Price falling, we don't see positive gamma. We are in a negative regime. See where is the zero gamma. This is the zero gamma. If you are here, maybe you can take a short position that you can close here in this level. Remember that in a negative regime, the volatility increases and you have to take advantage of this momentum regime. Here another example. Price over the 0 gamma, nothing on negative gamma. Price start to go up, you can take advantage of this, take a long here and close position in this level. See the coincidence when 0 DTE levels are in the 98 DTE levels. Here another context, retested many times. Here, go up, price over the 0 DTE. Maybe you can take a long position here over the 0 gamma for the QQQ, because blue is QQQ and white is NDX. A long position here, you can close in this level or let it run to this level or this level here. Here another analysis. Here you can see the 0 gamma for the QQQ. Also, price broke the the 0 gamma for the NDX is here. It's not represented here, but it's over here. And the 0 gamma for 0 DTE broke uppers here. You can take long. You can take a long here and get out one of your position in this level. But if you didn't took this position, you can wait a pullback, retest this level, and go long after rocking this channel, little channel, and get out of your position here in this L4 or let it run to this level. This did both level, 98 and 0 DTE levels. Here another example. Price over the 0 gamma for the QQQ. Maybe you can take a long position here over the 0 gamma for 0 DTE. You can take a long here and close position in this level. This did both level, 98 and 0 DTE levels. Here another example. Price over the 0 gamma for 0 DTE. Price touched the maximum Gex, price start to falling, and you can get a short position here after broke the 0 DTE levels. When do you get out? In this level. Okay, this is all the information that I want to give you today. I know that this is a long video, but I wanted to explain a little bit in detail how this strategy works and how we can take advantage of all Gex level. And also I wanted to explain you how to use the information that I use every day for my trading.